And welcome to the Daily Energy Markets podcast. We have Brent crude oil trading a little bit higher this morning in early trade in Asia at $85.40, holding that sort of move, although still you would say caught in the top end of the range that we've been in, $84 a barrel Brent average for the first half of 2024. Happy days for everybody, you would think, producers and consumers. But nonetheless, there is a somewhat upward motion in the oil price. Global head of derivatives of BB Energy, Omar Najee, as always, kick us off this Monday morning. Bullish moods in the market. We're seeing the backwardation, Omar, double in the last month from $2 to $4.
Yes, and who'd have thunk it?
Who would
So,
have done?
who would have thunk it? I mean, we're quite
Joe
surprised. So
Biden,
everybody,
baby, he's a genius.
yeah. And Joe Biden, by the way, all the Democrats are like, you
I
mean
had to get it
you
out
mean
there before you did. I
he's
had to get it out
he's
there before you did.
he's got dementia? Really? Oh, what a shock! Oh no, got to do something now. I mean, you couldn't write this stuff. So basically,
Oh
our
my God.
views have not changed. So oil, basically, to the surprise of many, is headed higher. I think we are. Like I said basically that 67, 70 low that we saw earlier this year is going to last for a long time. We set a high from 67 to 87. We then retraced from 87 down to about 72. And now I think we are going to set new all-time highs given time. So in other words, the lows in the market have been set for a very, very long time, I believe. So we're bullish oil. Market can dip from here. Maybe we go back, test 77, but the trend is higher. So I don't expect people to be selling. The market is still quite short. So there's still a lot of short covering to go. And then, if you look at exogenous markets, you look at the S&P, same story, trend is higher. You look at gold, trend is higher. You look at Bitcoin, trend is higher. You look at basically all the inflation levels, people are telling you like, no, inflation's under control and all this kind of stuff. And that's simply to facilitate the need of the Fed because the Treasury Department needs to borrow money to cut rates. They will cut rates no matter what. And basically they will spur markets to, even higher highs. So basically, and the EU will print money and, the political landscape has shifted completely. So anybody who was pro-Ukrainian war massacred. Anybody who's basically pro-green, like the Democrats, will shortly be massacred. Anybody who's pro-fossil fuels, like Trump, will, I think, win. Anybody who's pro-crypto, Bitcoin, all the rest of it, which is Trump, will win. So you're seeing a fundamental sea change. So we are bullish markets, and the only thing we don't like are cash and the dollar.
Jane Maru, head of market intelligence and analytics for the Middle East and North Africa for Vortexa. Jay, there's a lot of optimism priced into this market at the moment. We're seeing, as I said in the intro, the backwardation double from $2 to $4 in 1 month. There's a big expectation of a serious inventory draw in the third quarter. Your outlook for that to actually transpire?
Yeah, so good morning, everyone. Sean, thanks for the question. On inventories, we are seeing a little bit of a divergence actually when it comes to the trend with what's happening at the Atlantic Basin and the Pacific Basin. We haven't seen inventories really change that much in the Atlantic Basin. They had been building and now they've kind of flatlined, whereas in the Pacific Basin, we're seeing a little bit of a drawdown now, having climbed in recent months. The most important country here is obviously China, and that's where we're still not seeing this massive drawdown in inventories take place. And so for that reason, you could say that the bullishness when it comes to oil prices somewhat tempered because of this lack of bullish story when it comes to China. However, on the other side of things, what we are seeing in our own data when it comes to oil at sea, oil on the water, especially when it comes to crude, there is a market decline on crude in the water. So we are seeing signs of global crude supply tightness in the short term.
Henning Bloistein, Director, Energy, Climate and Resources at the Eurasia Group. Henning, it is a year of elections. There's no doubt about it, and of course the big one in November. But we've had a few already, including we're in the midst now of a French election. Let's just start there with the results over the weekend. Obviously, as expected, the far right party of Marine Le Pen has done very well. Your thoughts on the outlook for that election? What does it mean for Europe? What does it mean for all the tangential stories connected to Europe?
Yeah, sure. Thanks. So the far right looks like it's gotten slightly above a third of the vote in the first round. So the outlook is that in following the second round of voting, they will fall short of getting a full majority in France's parliament, which means that they will struggle to present the prime minister. Now, that a lot of people will say that's good news in itself. And you saw a slight rally in markets this morning over it, but it isn't really good news because what this means is that there's going to be what's called probably a hung parliament. That means blockage. There will not be an ability by France's parliament to make any sort of constructive decision policy making. For the EU, this is also bad news. France is arguably the most powerful political actor within the EU, and the EU, requires consensus making to function properly, which we've seen over the last couple of years. But when one of its biggest members isn't really functioning properly, that's bad for the EU. So it's not particularly constructive for the EU.
And just to follow up on that, Henning, from the point of view of expectations, given everything is, at least from a market point of view, have we met expectations? The idea that the far right has not it doesn't look like it will create a majority, is that below expectations, or could they still do so in a coalition with other right of center parties?
Yeah, they could. I mean, they're going to try as well. So we've just overnight put out our new odds. So we currently think at Eurasia Group that there's a 35% chance of a far right majority sort of coalition building, which we previously had 30%. But we do see a 65% chance that what's called a Republican front will form, where sort of the left and the centrist right, what remains of it, will kind of form coalitions locally to block the far right candidates. But this is political game. Brinkmanship is going to happen now. Next week, there'll be a lot of moving around at local level to see who has the best majorities. And both sides will try. We currently think sort of the broad center will prevent a far right majority, but that doesn't mean that they will then create a functioning majority themselves, and that's a problem. We're looking at a pretty sclerotic France in the next couple of months, and that's a real issue, even if it's not the worst case scenario.
Omar, looking out to the second half of the year, it is the 1st of July. We've had an average oil price of $84 on Brent in the first half. This idea of the bullish sense of outlook. We've kind of bar our breakthrough 90 on Brent during the sort of peak of the Iran-Israel face-off in May. We've kind of been stuck in this 85 nearly as a ceiling rather than a floor. Does this break out in the second half for you? It hasn't really got there yet in the first half. The breakout to the sort of bullish upper end, or does this ceiling hold, do you think? What breaks us out of this?
So, look, I think basically the answer is not only are we going to break out, but I mean, it's telling. If you look at these shows and you rewind back in time every week and whatever, the unexpectation of bullishness. Everybody's always saying like, no, so we're going to go sideways and nothing's going to happen, and it's going to be maybe a little bit up, maybe a little bit down, all that kind of stuff, right? The problem is with markets is that we are seeing major instability in everything. We're seeing major instability in basically politics, geopolitics, wars, and I think basically markets don't take kindly to that. They don't take kindly because they see what's happening in an election year. All that's going to happen is you're going to see the US print money. Their deficits, when the new president comes in, are just going to grow and grow big time. And if you look at the history of their deficits, they're basically not just ballooning, but they're now parabolic. So what you have is a lot of cash. I mean, look at Nvidia. Look at the S&P. S&P is trading 5,000. We're looking for it to close the year at 6,000, maybe 7,000, 6,000 plus. Oil, we're not looking at Brent going to 91 and whatever. We're looking at triple digits. So I think there's a lot of, and I like the fact that people are incredulous and like, oh, no, everything's okay, whatever, because they're going to be absolutely steamrolled. We've already seen the initial move that we've had from WTI moved from like 72 to 82 plus or minus $10 a barrel in 15 days, 2 weeks. So I think what you're going to see is further steamrolling, and you're going to see it basis not what's happening in terms of geopolitics, in terms of the wars, because those really don't affect anything to do with supply or demand. But I think if you look at stuff in real terms, if you look at where oil is compared to where it was 10 years ago, it's extremely cheap. It's dirt cheap. If you look at the purchasing power of the dollar, it's nosediving, and it's been nosediving for 50 years. It's like the Biden thing. Oh, does he have dementia? It's like, oh, is the dollar really weakening? So I think you get a combination of that, and people want to put quote unquote money to work. Oil is extremely cheap.
Is it a kind of, is it in your sort of vision as you see the market? Will it be a kind of a, oh my God, the king has no clothes moment, that this is not a gradual, that it's suddenly a sudden black swan, but not a black swan because you're seeing it for quite a long time coming over the horizon in that regard?
You're seeing something that you haven't seen in 500 years, which again, people don't realize will stick their head in the sand. You're seeing the end of Western hegemony. You're seeing the end of things like the IMF, the World Bank, the ICC, the G7. You're seeing the end of that, and you're seeing the emergence of something new. You're seeing the end of the basic model that says we print paper and we buy all we need with this paper. So we, as the US, we print the dollar and we buy oil, we buy grain, we buy whatever it is that we need, aluminium, platinum, titanium, whatever, in exchange for this paper. That's been the Western model of economic growth for, since the Second World War, coupled with massive debt that everybody in the West always says, it doesn't matter. It doesn't matter what debt to GDP is. It doesn't matter what fiscal deficits you're running. It doesn't matter. I think as time ticks and you have new centers of power like the BRICS, and you have basically a shift of power from basically producers to consumers, or consumers to producers, that's going to lead to an uptick in prices.
We had yet another voice adding to the deficit concerns over the weekend, with the Bank of International Settlement also screaming, joining the IMF and others, that this does matter. Jay Maru, looking at the sort of second half of the year, the first half, we did have the issues around, obviously, the Strait of Hormuz, or not Strait of Hormuz, excuse me, the Red Sea bottleneck, the Houthi activities there disrupting flow of shipping. We've had the ongoing issues related to the Panama Canal as well, with drought, etc. What does that look like now as a sort of one of the floorboards under this oil price, this sort of disruption to global flows?
So I think these issues are here to stay. I mean, there hasn't really been any material change on the shipping side in the way oil moves on the water in the past few months as a result of these difficulties. And now the world just understands that shipping is more inefficient. Global trade when it comes to oil and products is more efficient. One of the main routes that had been affected by this is the diesel flow from east to west. And thankfully, depending on your perspective, it hadn't been affected as much because Europe hadn't been taking so much diesel from the east in recent months. However, if there is any uptick in demand from the European side, particularly if potentially we have a strong winter diesel demand situation happening, that could once again really tighten freight rates. That could push up diesel price in the West. And it could facilitate something that we're actually seeing a little bit happen right now. And this is ships like Suezmaxes and VLCCs, so the very largest tankers that carry crude oil, cleaning up, so-called, cleaning up so that they can carry diesel. So this is a phenomenon that's already happening now, but in a very small level at this stage, but it's something that we could see happening even more so in the coming weeks and months, especially as we head in towards the end of the year.
What about, Jay, just to follow up on that other stress from the first half of the year that started to dissipate? I mean, the sanctions issue, but the dark fleet, the amount of vessels that were available and participating in the delivery of sanctioned oil from Russia in particular. What is the outlook for that at the moment?
Yeah, I think it's really important. A lot of people talk about the sanctioned fleet, the dark fleet, the grey fleet. There's so many different names, but I think what we do at Vortex, we try to make this quite simple. There's the dark fleet, which is those tankers which ship oil without AIS on, and this is primarily Iran and Venezuela sometimes as well. What we've seen is that Iran's exports have continued to rise. We've seen May exports hit 1.7 million barrels a day. So clearly there's no issue with Iran exporting oil, whether it's using the grey fleet or the dark fleet or the sanctioned fleet, however you call it. With Russia, it's a slightly different story here. Russia, their exports have changed somewhat, but their total export level hasn't changed. What's changed is the profile of their customer. Increasingly, what Russia has done is it's shifted more of its exports towards India at the expense of China. That goes back to the point I was making before, where Chinese oil import demand doesn't look so great. And so with China, with Russia effectively having only two real major customers, what they've done is pivoted more towards India. And as a result, India's exports of Russian oil are at record levels. The private refiners are importing so much oil, and that's really backing out actually some of the Middle Eastern grades that they were previously buying before.
Henning, what are the other aspects that was sort of very prominent in the first half of the year in its moments and then dissipating again was the geopolitical risk premium on the oil price, with most spectacularly moving Brent above 90 during the Iran-Israel face-off. But we've also had moments in the first half when the Ukrainian drone attacks on Russian infrastructure was quite significant. And there's reports overnight of a swarm, as they call it, 25 drones heading into Russia, targeting, one presumes, infrastructure of some description. How much do you think this will play into the second half, this geopolitical risk, particularly in the Ukraine theater with Russia, and the potential for that to remain elevated for the markets?
I think so. These drone attacks by Ukraine into Russia, we don't actually think at this stage have the ability to majorly impact global oil supply because, yes, they're pretty frequent and they go far into Russia now, but they are not particularly big drones. And Ukraine doesn't have the big missiles that would really take out an entire refinery at this stage. Things could change, sadly. The war has escalated more and more, and there is talk of more missiles going to Ukraine, that they might use them. But at this stage, we don't think that'll be the case. But that still means, I mean, it is a major conflict that's, in Europe, and it's affecting one of the biggest oil suppliers. And that means that and there's sanctions all over the place. And that means that it's priced into the market to some extent and continue to do so because we're heading straight for a third winter of war in Europe. And it's similar to the Middle East. I mean, Omar said earlier, yeah, it's true that this conflict hadn't really massively affected the supply of oil, but it's distorted stuff. You have to take detours. There's a risk premium priced in, and that will continue until these conflicts are resolved. And unfortunately, we don't really see a credible solution to either of these conflicts right now.
And Henning, just to follow up on that, there's a big article in the Bloomberg overnight, which we've included in our daily digest, that says Le Pen's win in France is a big win for Putin. Can you just connect the dots there for us as to what this looks like from the point of view of the sort of the ripples out from this election result in France? That we've already seen the move to the right in Holland in the election there a few months back.
Yeah, well, so initially the concept is that Le Pen, favors, but has good ties with Putin and favors an immediate ceasefire, and has implied that her or her supporters in power would stop French support for Ukraine. But Jordan Bardella, would probably be her prime minister if she ever came to power, which is possible, of course. But he's now actually said that he would continue some form of support for Ukraine by France, but not put troops on the ground. So, but you can see that the far right in France has actually dialed back quite a bit on its Russia policies, because they've seen that if they come out too favorable of Russia, that they actually lose quite a lot of votes. The biggest thing here is not France. It'll be what happens in the United States later this year if Trump becomes president and withdraws support for Ukraine. And that's the one to look out for. I think Europe, I mean, they've dedicated more than 50 billion euros of aid this year already to Ukraine, and they probably do that again, but that's not going to be enough by itself to keep Ukraine's defensive ambitions alive. So it's all dependent on what's happening in Washington.
Okay, let's go to the survey question, which is sort of tackling the point I made early in my commentary this morning. Oil traders are pricing in a big inventory draw in Q3. Although the data thus far is not supporting this transpiring, it may still do so, but thus far we're not seeing that big inventory draw. So this pricing in the doubling of the backwardation in the markets over the last month from $2 to $4 based on a big inventory draw that we're yet to see. So do you agree with the traders pricing this in, agree that we'll see a big inventory draw or not? Omar, just to pick up on the sort of comic nature of our earlier comment, but nonetheless very serious idea that over the last few days, the increasing likelihood or percentage of success for Donald Trump is increasing. I think it's above 60% now. And ultimately, you mentioned in your earlier comment that means the guy likes fossil fuels more drilling, more crude oil out of the US, which is fairly flat this year. How do you circle that square with more supply from the US and at the same token keeping the oil price elevated when obviously the more or less traditional outcome of more oil is lower price? So how do you see all of that squaring out?
So basically, you have to, first of all, you have to take a step back, okay? So you're not seeing a doubling of backwardation and I don't know what. You have to go before that. So basically what you saw is a massive amount of selling that came into the market, right? In an attempt to push prices lower, push that backwardation down, etc., etc. If you look at CFTC reports, which tells you how short or long players are in the market, they were at historical highs in terms of short on diesel that have never been seen, like Trump says, never ever been seen in the history of the world, blah, 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 blah. So you're coming off that. You're not coming off basically a normal market. You're coming on at a historically extremely short market. So I would suggest to you that what you're seeing now is not a doubling. What you're seeing now is that cork just kind of, was pushed a meter down. It's just about halfway up. It's going to get to that surface and then it's going to basically jump up. So that's one. In terms of Trump, so basically, you can forget about anything to do. I mean, the idea that still persists to this day that somehow, fracking in the US makes money is a joke. On an industry-wide basis, it costs more money to get that oil out of the ground than it does in order to sell it. And the only reason we saw fracking and we saw that whole industry emerge is because we had interest rates at zero. It is highly, liquidity money intensive. If you have interest rates at 5%, you can forget about anything to do with shale. You can basically cross it off the mark and forget about it. And these shale wells deplete like crazy. So what Trump wants to do, from what I've seen, basically, he wants to support the fossil fuel industry, not because he's nuts or something, but he wants to use the cheapest energy there is, whether it be coal, whether it be gas, whether it be oil. And why are people moving away from the Democrats? So the Democrats is the green vote. And why are they moving away in terms of Europe is because they've seen their energy bills come in at stratospheric numbers. It's not that people in Europe are basically getting out pitchforks and all of a sudden they've become fascists. No, it's because basically energy prices have moved up so massively. This was supposedly the green, revolution, and they've messed it up completely. It doesn't work. Massive subsidies, electric cars, tree hugging and all the rest of it. People don't want it, and they're going to vote for, they voted for not wanting it. So Trump is going to come in and basically, again, tilt the balance back to normal. He's not going to come in and basically say, drill everywhere, do everything, but definitely tilt the thing. And I think it's good for the industry.
Jay, I mean, looking at the sort of outlook for the second half and the year as a whole, we still have these very divergent demand growth forecasts from OPEC plus, OPEC. You always have to get your pieces right now. OPEC plus, OPEC, the Great Eight that are additional cuts. It's a few pieces to keep track of, but ultimately OPEC have forecasted a demand growth of in 2024 of 2.2 million barrels a day. They stuck with that in their June report. IEA have stuck with their like 1.1 million barrel a day difference there. Based on Asia's first half, which is essentially flat to negative in terms of demand growth, you're going to have to see a bionic output just to get to IEA levels, never mind OPEC levels. How do you see that playing out in the second half? Which of those forecasts at the levels that we're likely to see and the market adjusting to that inevitable outcome?
Yeah, I mean, I think it's clear there's that clear divergence in the views for oil demand growth. Definitely closer towards the lower side of things, given where we've been in the first half of the year. That's not a difficult call to make. As I said before, disappointing oil demand, disappointing oil import data from China is a key driver for this, in my opinion. And that doesn't show any signs of really changing in the next 6 months, not anywhere to the level where it can revise full year forecasts for oil demand. So definitely on the slightly bearish side of things when it comes to global oil demand growth for the rest of this year. One thing that we have to mention on the supply side is that given the latest announcements by OPEC, or the coalition of eight, sorry, as you said, Sean, to get the wording correct, what we should be mindful of is come next year, come September 2025, when these production cuts starts really unwinding, Saudi Arabia and UAE as a combination, they can add up to 1.5 million barrels a day in production over the next 12 months from September 2025. So if there is any sign of real growth in oil demand, expect those two countries to really be gaining market share quickly at that period of time. But up until then, there isn't really any major signs from OPEC of any sharp increase in production. So that fits in with a slightly more bullish narrative on prices from a supply side. But yeah, definitely China is the main factor in all of this. No real bullishness coming from there, in my opinion.
And India now increasingly looking like with a somewhat of a hung parliament, not quite, but ultimately their big engine of growth might be stunted by that election result there. Henning, I wanted to give you the last word this morning, just to give us a sort of a wider European sort of perspective. We got a 50-50 on our agree-disagree there. But in terms of the European outcome now with this surprise. I mean, this election in France was not one on the list only a few weeks ago. It has now come on the list because of the European Parliament elections. And you've got Ursula von der Leyen. So you've got von der Leyen, you've got Le Pen, you've got Meloni in Italy. How is this all going to play out, you think? Firstly, does von der Leyen get easily ratified by the European Parliament? The shift to the right, what does this look like?
So Europe at the moment looks a bit messy, but not quite as bad as people have thought it might turn out. So as we discussed before, the French elections, the snap elections called by Macron a couple of weeks ago really weren't on the radar, including on ours. But the outcome we're now probably seeing is that most likely he's not going to be far right prime minister, but it is going to be a parliament in France that can't make big decisions. That means that Europe can't probably move its more ambitious agenda forward. Von der Leyen will probably get a second term. the only person who tried to prevent her was Meloni last week, and but we think that'll hold. Weirdly, though, because despite all the headlines in the European Parliament, the center majority is actually held. It's moved from center left to center right. The kingmakers in that coalition are still the Green Party, even though they've lost quite a lot of support. But it's a bit weird. But so at the moment it's still holding, but there's trouble brewing. I mean, Germany has three state elections actually in the coming months. They won't produce a shift in the government, but the big problem in Europe's big economies is that they're all weak governments at the moment. The French government is weak. The German coalition is weak as kittens. They can't agree on anything. And so Spain is weak. So there's really no big, strong governmental drive in the EU at the moment. Weirdly, it looks like the UK will have a strong majority. Whether one is supportive of that is irrelevant at this stage, but they will probably have a strong majority come next week. So that's a bit counter-cyclical, but it's not quite as bad as people thought, but it's not great. That's our outlook for Europe at the moment.
Well, it will certainly be a big weekend next weekend as well with the British French election. We start to see how the future of Europe looks over the coming years with a return of Trump 2.0. The last thing it can afford is to be weak and fractured, but that might be the cards that are delivered. Putin on one side here and Trump on the other. Not a great sandwich to be in the middle of. Omar Najee, as always, awesome. Monday mornings in Dubai. Jay Maru, thank you so much from Vortexa. And Henning Doystein from Eurasia Group, thank you very much for your insights this morning. With Brent crude oil trading handsomely at 85, above $85 a barrel. Oil producers will be very happy with that as long as it stays there for the rest of the year. Hard to see any big reasons why it wouldn't go, the average remaining 84 in the first half. You sort of bet your dollar that it's going to be at least that in the second half, unless there's some surprises on the downside. Thanks, everybody. Have a great week. All the best. Bye-bye.
Thank you.
Thank you.